The car market is falling apart, prices are skyrocketing, repossessions are soaring, and dealerships are drowning in unsold inventory. This could be the crash we all feared. From manufacturers cutting thousands of jobs to vehicles losing 30% of their value in just 6 months. The car market of 2025 is a perfect storm. But what's driving this unprecedented crash? Why are automakers in survival mode? And how can you protect your wallet during this apocalypse? What's happening? Picture this, rows upon rows of brand new vehicles sitting untouched at dealerships. Their once shiny exteriors now coated in dust. These are not just any vehicles. They include icons like the Ford F-150, the Chevrolet Silverado, and the Ram 1500, models that once flew off the lots as fast as they arrived. Today they sit unsold for months, with price tags that make even the most enthusiastic buyers think twice. The sight is not just a problem for dealerships, it's a sign of a growing crisis in the automotive industry. The car market, long considered a symbol of economic health and consumer confidence, is facing unprecedented challenges. Sticker prices are soaring, interest rates are skyrocketing, and the inventory glut has reached levels unseen in nearly a decade. This isn't just a slowdown, it's a ticking time bomb. If you think the car market is stable, think again. What's happening now is reshaping the way Americans think about buying and owning vehicles. The price surge problem. The first warning sign? The sticker shock. Since 2019, the average manufacturer's suggested retail price for vehicles has risen by over 40%. A truck that costs $35,000, even entry-level sedans and compact cars are pushing the limits of affordability. Why? Automakers have shifted their focus to high-margin models, packing vehicles with luxury features and tech upgrades that many buyers simply don't need or can't afford. This strategy worked when the economy was strong and interest rates were low, but now, with rising inflation and tighter budgets, the strategy is backfiring. For the average consumer, the price hike feels like a betrayal. Vehicles were once seen as tools for work, travel, and freedom. Today, they're becoming status symbols that only the wealthiest can justify buying. Loan and financing chaos. It's not just the price of cars that's causing headaches. It's how people are paying for them, or rather, how they're struggling to pay for them. The average monthly payment for a new car loan has climbed to over $760, and 1 in 6 borrowers is paying more than $1,000 a month, with interest rates averaging 7% for new cars and over 11% for used vehicles. Financing has become a nightmare. The result? Negative equity. Many buyers now owe more on their loans than their cars are worth. On average, $7,200 more. This means that even if they try to sell or trade in their vehicle, and when budgets tighten, auto loans are often the first payments to be skipped. Repossession rates have surged by over 23% in the past year, leaving families without transportation and dealers with even more unsold inventory. This is more than a financial issue. It's a ripple effect that touches every corner of the market. Shifting consumer preferences. Buyers are increasingly turning to used cars, compact SUVs, and hybrid models that offer better fuel economy and lower price points. Younger generations, especially millennials and Generation Z, are looking for vehicles that align with their values. Think electric options, minimal environmental impact, and advanced tech features. At the same time, brands like Toyota, Subaru, and Tesla are capitalizing on these shifts, offering affordable, reliable, and innovative alternatives that are stealing the spotlight from traditional American automakers. If these trends continue, the car market could face a collapse that changes the way we buy and own vehicles forever. But what's behind these dramatic shifts? Is there any way for automakers and dealerships to recover? And how will all of this impact you? Stay tuned, this is only the beginning. The inventory overflow. Across the United States, dealership lots are overflowing with vehicles, many of which have sat unsold for months on end. This crisis is not just an anomaly, it is a symptom of a larger systemic failure within the automotive industry. At the heart of this issue lies overproduction and misaligned market strategies. Take the Ford F-150, a long-standing icon of American trucks. Historically, this model flew off dealership lots, celebrated for its rugged durability and wide appeal. Yet now, thousands of these trucks are sitting idle, with some collecting dust for over 220 days. This is not an isolated issue. It is emblematic of a nationwide trend affecting brands like Ram, Chevrolet, and Toyota. The problem began with automakers banking on sustained demand for high-margin vehicles. Instead of focusing on affordability and practical features, manufacturers doubled down on producing premium models with hefty price tags exceeding $70,000. This approach worked briefly, particularly during the pandemic, when cheap financing and government stimulus buoyed consumer spending. But as economic conditions shifted, the strategy backfired spectacularly. For dealerships, each unsold car becomes a financial liability. They are burdened with flooring costs, which function like a credit card for inventory. Every month, interest accrues on unsold vehicles, cutting into profit margins and creating immense pressure to move inventory, even at steep discounts. But even significant markdowns, sometimes as much as $15,000 off the manufacturer's suggested retail price, have not been enough to lure buyers back. The result is a vicious cycle. Automakers continue to produce vehicles in a saturated market, dealerships struggle to offload inventory, and consumers remain priced out or uninterested in what is available. The longer this continues, the closer dealerships inch toward financial insolvency, with far-reaching consequences for the industry as a whole. The repossession surge. While dealership lots are full of unsold cars, another disturbing trend is unfolding: a surge in vehicle repossessions. Auto loans, once seen as manageable even for middle-income families, have become financial quicksand due to rising interest rates and inflated car prices. The data tells a grim story. Over the past year, repossession rates have increased by more than 23%, reaching levels not seen in over a decade. This means that nearly 1 in 4 vehicle owners who financed their cars have lost them because they could not keep up with payments. Negative equity is a major driver of this crisis. On average, borrowers owe $7,200 more than their cars are worth. This issue has escalated dramatically in recent months. Just a short time ago, the average negative equity was $6,600. The rise underscores the rapid pace at which the market is collapsing under the weight of unsustainable loans. For families, the loss of a vehicle often represents more than just a financial setback. It can mean the inability to get to work, transport children, or manage daily responsibilities. For automakers and dealerships, repossessions flood the market with used vehicles, driving down prices further and compounding the challenges of selling new cars. This surge in repossessions is not just a sign of individual financial struggles, it is a warning bell for the broader economy. When families cannot afford their car payments, it is often a precursor to deeper economic instability, signaling that household budgets are under immense strain from rising costs across the board. The role of rising insurance costs. It is not just car payments that are straining budgets. Insurance premiums have skyrocketed, adding another layer of financial pressure. Over the past 2.5 years, car insurance rates in the United States have more than doubled, and in some states, premiums have risen by as much as 60% year over year. For many Americans, car insurance is a mandatory expense, but its rising cost is forcing difficult choices. Younger drivers, already hit hard by high premiums due to their perceived risk, are being priced out of coverage altogether. Middle-income families are finding it increasingly difficult to balance insurance costs with other essential expenses like housing, groceries, and utilities. This issue has ripple effects across the automotive market. Higher insurance costs mean fewer people can afford to own and operate vehicles, which further reduces demand for new and used cars. It also pushes more drivers onto the roads without adequate coverage, creating a public safety risk and driving up costs for insured drivers. Moreover, insurance companies themselves are adjusting their risk calculations in response to the economic downturn. Rising repossession rates and declining car values make it harder for insurers to accurately assess and price policies, leading to even higher premiums. This vicious cycle creates a scenario where car ownership becomes increasingly out of reach for a growing segment of the population. For automakers and dealerships, the implications are stark. Without a stable customer base able to afford both vehicles and the associated costs of ownership, the market will continue to contract, leaving manufacturers scrambling to adjust their production and pricing strategies. The competition problem. While American automakers struggle to navigate these challenges, their competitors, particularly international brands, are stepping into the void. Companies like Toyota, Honda, and Tesla are reshaping the market with offerings that are not just more affordable, but also better aligned with the evolving preferences of modern consumers. Consider the Toyota RAV4, one of the best-selling vehicles globally. It offers a blend of reliability, fuel efficiency, and practical features at a price point that feels reasonable in today's economic climate. Similarly, Tesla has capitalized on its reputation for innovation and sustainability, making electric vehicles aspirational while maintaining competitive pricing through economies of scale. Even within the truck and SUV segments, where American brands have traditionally dominated, competition is heating up. Ford's revival of the Bronco has been a bright spot, but models like the Hyundai Palisade and Kia Telluride are proving that international brands can compete on capability, style, and technology. The electric vehicle market is another battleground where American automakers risk losing ground. While Tesla continues to lead, brands like Hyundai and Kia have introduced electric models that rival their American counterparts in both price and performance. Meanwhile, legacy automakers like General Motors and Ford have struggled to scale their electric offerings, often pricing them too high for widespread adoption. This competitive landscape underscores a critical issue for American manufacturers: the need to innovate while remaining accessible. As international brands capture more market share, the pressure on domestic automakers to adapt or risk irrelevance grows stronger by the day. The cracks in the foundation of the car market are widening, with inventory overflows, repossessions, rising costs, and fierce competition shaking the industry to its core. But what caused these problems to reach a boiling point, and can they be addressed before the entire market collapses? Inflation effect. The dramatic rise in car prices is not just a result of automakers inflating their margins. It is deeply intertwined with the broader economic environment. Over the past several years, inflation has driven up the cost of everything from raw materials to labor, making vehicles more expensive to produce. However, the automotive industry's response to this pressure has been anything but balanced. Manufacturers have leaned heavily into producing high-margin vehicles, prioritizing luxury trims and fully loaded models over more affordable options. The reasoning seems sound during a booming economy. Buyers were willing to pay for added features, and cheap financing made these vehicles more accessible. But as inflation hit household budgets and interest rates climbed, the strategy began to backfire. Today, many consumers find themselves priced out of the new car market entirely. What was once a manageable monthly expense has become an overwhelming financial burden. Even used cars, typically a refuge for budget-conscious buyers, have seen prices soar, further limiting options for the average consumer. This misalignment between consumer needs and market offerings has exacerbated the inventory crisis. Dealerships are stuck with expensive vehicles that buyers cannot afford, while those searching for affordable options find themselves with limited choices. The result is a market teetering on the edge of collapse, with automakers scrambling to realign their strategies amid shifting economic realities. Interest rates and the loan bubble. Another key factor in the car market crash of 2025 is the skyrocketing cost of auto loans. Over the past several years, interest rates have climbed to levels not seen in decades, making financing a vehicle significantly more expensive. For context, the average interest rate on a new vehicle loan now hovers around 7%, while used vehicle loans average over 11%. This shift has created a loan bubble where buyers are taking on increasingly unsustainable debt to afford the vehicles they want. The result? Monthly payments exceeding $1,000 have become alarmingly common, with nearly 1 in 6 car loans falling into this category. The repercussions are widespread. High monthly payments strain household budgets, leading to a rise in loan delinquencies and repossessions. At the same time, many potential buyers are being denied financing altogether, as banks tighten their lending criteria in response to growing economic uncertainty. This vicious cycle further depresses demand for new vehicles, leaving dealerships with unsold inventory and forcing automakers to reconsider their production plans. For the average consumer, the loan bubble represents a significant barrier to car ownership, effectively shutting them out of the market unless drastic changes occur. The impact of overproduction. For decades, the automotive industry operated on a production-driven model, churning out vehicles in anticipation of demand. This approach worked well during periods of economic stability, but in today's volatile market, it has become a liability. Overproduction has led to a glut of inventory on dealership lots, with some vehicles sitting unsold for over 200 days. This problem is particularly acute in the truck and SUV segments, where high production costs and premium pricing have made it difficult to move inventory. Manufacturers like Ram and Chevrolet have been especially hard hit. Ram, for example, has over 25,000 unsold trucks across the United States, many of which are high-spec models with price tags exceeding $70,000. Similarly, Chevrolet dealerships are struggling to offload trucks like the Silverado, despite offering steep discounts of up to $15,000. This overproduction is not just a logistical challenge, it is a financial drain. Every unsold vehicle represents sunk costs in materials, labor, and dealership expenses, eroding profit margins and straining relationships between manufacturers and their retail partners. Consumer confidence erodes. Perhaps the most significant factor driving the car market crash is the erosion of consumer confidence. In a climate of rising costs and economic uncertainty, buyers are increasingly hesitant to make large financial commitments, particularly for high-ticket items like vehicles. This hesitation is fueled by several factors. First, the perception that vehicles are overpriced and underperforming has made many consumers wary of new purchases. Frequent recalls, quality concerns, and subpar reliability ratings have further damaged trust in automakers, particularly among legacy brands like Jeep and General Motors. Second, the broader economic landscape is contributing to a sense of financial instability. Rising insurance premiums, inflated loan payments, and higher living costs have left many families feeling stretched thin. For these households, the idea of taking on additional debt for a new vehicle feels risky, if not outright impossible. The erosion of consumer confidence is a complex issue that extends beyond the automotive industry. It reflects deeper anxieties about economic stability, affordability, and the value proposition of large purchases. For automakers, rebuilding this confidence will be a critical challenge in the years ahead. The root causes of the car market crash are deeply interconnected, painting a picture of an industry grappling with systemic challenges. But what does the future hold? Can automakers adapt in time to prevent further decline, or is the crash inevitable? The role of electric vehicles in a shifting market. Electric vehicles, once considered a niche market, are now at the forefront of the automotive industry's transformation. As traditional automakers face the dual pressures of declining consumer demand and skyrocketing production costs, many are betting on electric vehicles to revive their fortunes. But can electric vehicles save an industry in crisis? The transition to electric vehicles has not been without its challenges. For one, the high cost of battery technology has made electric vehicles more expensive than their internal combustion engine counterparts. While government incentives have helped offset some of these costs, they are not enough to make electric vehicles universally affordable. Infrastructure is another hurdle. The lack of widespread charging networks remains a barrier for potential buyers, particularly in rural areas. Automakers and policymakers must invest heavily in expanding this infrastructure if they hope to make electric vehicles a viable option for the majority of consumers. Despite these challenges, the potential benefits of electric vehicles are undeniable. Lower operating costs, reduced environmental impact, and cutting-edge technology make them an attractive choice for forward-thinking consumers. For automakers, the shift to electric vehicles represents an opportunity to redefine their brands and capture new market segments. However, the success of this transition will depend on more than just innovation. Automakers must address the affordability gap, ensuring that electric vehicles are accessible to a broader audience. They must also rebuild trust with consumers. The reshaping of dealership models. The traditional dealership model, long the cornerstone of car sales in the United States, is under intense scrutiny. As inventory piles up and sales slow, dealerships are being forced to rethink their business strategies. One major shift is the move toward online sales. Platforms like Tesla's direct-to-consumer model have shown that buyers are increasingly comfortable purchasing vehicles online, bypassing traditional dealerships altogether. This trend has forced legacy automakers to invest in digital sales channels, streamlining the buying process and reducing the need for large physical inventories. Another change is the rise of subscription services. Some automakers are experimenting with models that allow consumers to pay a monthly fee for access to a range of vehicles rather than committing to a single purchase. This approach appeals to younger buyers who value flexibility and are less inclined toward traditional car ownership. For dealerships, these changes present both challenges and opportunities. On the one hand, reduced foot traffic and the shift to online sales threaten their traditional revenue streams. On the other hand, embracing new models could help them stay relevant in a rapidly evolving market. Government policies and their impact. Government intervention has always played a significant role in shaping the automotive industry, and the current crisis is no exception. From tariffs on imported materials to incentives for electric vehicles, policy decisions are influencing the trajectory of the market in profound ways. One of the most impactful policies has been the push for stricter emission standards. These regulations have accelerated the transition to electric vehicles, but have also increased production costs for automakers. For brands already struggling with affordability, the additional burden of compliance has been a significant challenge. At the same time, government incentives for electric vehicles have created opportunities. Tax credits and rebates have made electric vehicles more accessible to consumers, driving demand and encouraging automakers to expand their offerings. However, these incentives are not evenly distributed, with some states offering more robust programs than others. Another area of policy impact is infrastructure investment. Federal and state governments are beginning to allocate funds for the expansion of charging networks, a critical step in making electric vehicles a practical choice for more Americans. Finally, trade policies have had a mixed effect. Tariffs on imported materials like steel and aluminum have increased production costs, while trade agreements with countries that produce critical battery components have helped secure supply chains. What this means for consumers. For the average consumer, the car market crash of 2025 is both a challenge and an opportunity. On one hand, rising costs and economic uncertainty make car ownership more difficult than ever. On the other hand, the industry's upheaval has created opportunities for savvy buyers willing to navigate the shifting landscape. One immediate impact is the availability of discounts and incentives. As dealerships struggle to move inventory, buyers can take advantage of steep price reductions and favorable financing terms. For those in the market for a new vehicle, this is a rare opportunity to negotiate and secure a better deal. Used car buyers are also benefiting from the market's instability. As new car prices soar, the demand for used vehicles has increased, but so have the available options. Buyers willing to shop carefully can find high-quality used vehicles at a fraction of the cost of new ones. For those struggling with the cost of car ownership, alternative options like ride sharing and public transportation may become increasingly attractive. This shift could further reshape the market, reducing demand for personal vehicles and encouraging automakers to explore new business models. The car market crash of 2025 is not just an industry event, it is a moment of transformation that will impact every driver, buyer, and manufacturer. As we move through this period of upheaval, the choices made by automakers, policymakers, and consumers will shape the future of transportation for decades to come. What do you think about these changes? Are you optimistic about the rise of electric vehicles, or do you miss the days of affordable, reliable cars? Let us know in the comments below. Your thoughts drive the conversation, and we cannot wait to hear what you have to say.